Today, let's think about taxes as if it's a war. It's us versus the IRS. Most people are trying to win individual battles while losing the war. Wouldn't you rather sacrifice a few small battles in order to win the war? Just about every person I talk to asks for ways to reduce their income taxes. It's almost always in reference to filing their current year tax return. And yet it seems like very few people take a big picture approach to reducing their lifetime tax expense. The first does not automatically result in the second. It's possible to reduce the current year taxes and that result in a higher lifetime tax burden, the equivalent of winning a battle but losing the war. Alternatively, you may pay more in taxes in one particular year, but reduce your overall taxes when looking at the cumulative effect over multiple years. That's the equivalent of sacrificing a few battles to win the war. So how do you do that? I'm glad you asked. In this video, I'll give you 6 ways to focus on the big picture, even if it means paying more in taxes in the current year. My name is Brad. I'm with Wooten CPA. Our goal is to bring peace to your tax and financial responsibilities. One of the ways we do that is through these videos. Please like this video, share it with others, and subscribe to the channel so that you're notified when new videos come out. Thanks for watching. Paying less in taxes this year doesn't always translate into paying less tax over your lifetime. It's a short-term view, and taking a big picture, long-term view can save you taxes over the course of your life, even if in one particular year it didn't save you anything at all. In other words, let's win the war, even if it means sacrificing 1 or 2 battles along the way. Let's jump in with an example that means paying higher taxes in the current year, but less taxes overall when taking a big picture approach. When you contribute to a Roth IRA, you're paying more taxes in the current year than you would be if you contributed to a traditional IRA. As a quick side note, I have a video that you should watch where I talk about how neither of these accounts is inherently better than the other. Not many people understand what I talk about in that video, and by watching it, you'll be ahead of 99% of taxpayers in understanding these accounts and when to use one over the other. Now back to our first tip for taking a big picture approach to tax savings. If your tax rate is low now and you have good reason to believe it will be higher in retirement, then you should likely utilize Roth contributions. This will mean your tax is higher this year, but when considering the big picture, you'll save more in retirement than you pay now because you expect your tax rate to be higher in retirement, and the Roth distribution will be tax-free. Number 2, accelerating income or deferring expenses. This is the opposite take on a pretty common strategy of doing the exact opposite, which is accelerating expenses or deferring income. These strategies are available to cash-basis taxpayers, which most small businesses and self-employed taxpayers are. But why would you accelerate income or defer expenses? Both of these options would increase income in the current year and therefore result in more taxes this year. Well, if you expect next year's taxes to be higher than this year, you might want to do that. It would increase taxes this year, but would still be lower than what you would pay next year if the tax rates are higher. One example is if you have lower income this year and expect a higher income next year, or if you know the tax rates are going to go up the following year, which under current law is exactly what is set to happen in 2026. So this might be a good strategy for some people in 2025. A third strategy is investing in real estate. Rental income is not subject to self-employment taxes, except in rare situations. By investing in real estate, you are generating income not subject to Social Security and Medicare taxes. You also would take depreciation on the rental property itself, which is a non-cash deduction that you get every year that shields some of that income from being taxed. You have to recapture depreciation when you sell the property, but it might be limited to a lower rate than your ordinary income. That depends on your tax bracket. Either way, the capital gains above and beyond the depreciation recapture would be long-term capital gains, which are taxed at a lower rate than your ordinary income. Another strategy along those same lines, investing and generating long-term capital gains, is another good long-term strategy. Your regular earned income, whether it's W-2 employee income or self-employment income, is the highest taxed income that there is. If you invest in stocks or other capital gain items to the point where one day they are providing a significant portion of your income, you would reduce your overall tax burden because long-term capital gains are taxed at lower tax rates than ordinary income. This doesn't save you or cost you anything in terms of taxes in the current year when you're investing, but it saves taxes in the future when you can reduce your high-taxed regular income and start to live off your lower-taxed capital gains income. Another one is investing in mutual bonds. It doesn't save any taxes today, but the interest income is tax-free for federal tax purposes and can reduce your taxes in the future. Lastly, an excellent way to get completely out of taxes altogether is to die with built-in capital gains. Depending on the size of your state, there may be some taxes to your estate, but under current law, probably everyone watching this video would not owe any estate taxes. If you have rental property or stock or other investments that have increased in value since the time you purchased them, then you have built-in capital gains. If you die, your heirs will get a step up in basis when they inherit those items. Let's look at an example. Say you have McDonald's stock that you bought for $1,000 50 years ago, and now it's worth $500,000. If you sell it, you'll have $499,000 of long-term capital gains. That's better than ordinary income, but it'll still be a large tax bill. If you gift the stock to your child, then they get your basis of $1,000. This is called carryover basis. And if they sell it, they'll have the $499,000 of long-term capital gains. But if you keep it until you die and they inherit it, their basis will step up to the current fair market value, appropriately called step-up basis, which we said in this example is $500,000. And if they then sell it at that amount, they'll have no gain and pay no tax. Even if they hold it and sell it later, it continues to go up in value. Their basis is now that $500,000, and no one had to pay tax on the increase of $499,000 that happened during the period in which you owned it. Inheriting built-in long-term capital gains is the best way I know of to completely skip out on taxes altogether. That wouldn't necessarily be the case for every single estate, but with the estate limit where it is right now, it's going to be the case for about 99% of them. So there you go. 6 strategies that don't save any taxes in the current year. A few of them actually increase the taxes in the current year, but they all lower your overall tax burden over your lifetime. I'd rather take a big picture view and reduce my overall lifetime tax burden than focus on just the current year and cost myself more in the long run. So stop sacrificing everything for individual battles while losing the war and start winning the war instead. Isn't that a better goal? If you found this video helpful, please share it with others so they can benefit from it as well. Thanks for watching.